There is this assumption we all just seem to accept as a law of nature these days.
Right, that the algorithms always win.
Exactly. The idea that robots are taking over
Yeah.
and, anything a human can do, a machine can do faster, cheaper, and with like zero emotional bias.
Yeah, I mean, it's the dominant narrative across almost every sector. And when it comes to global finance, that narrative feels absolutely untouchable.
Oh, really?
The popular image of modern trading is just a massive chilled server farm in New Jersey somewhere, just silently swapping billions of dollars in fractions of a millisecond.
Yeah, and the human broker. They're supposed to be extinct. Just a relic from the 1990s yelling into a phone at a trading floor.
It ain't much.
But welcome to the Deep Dive Learner, because today we have a stack of financial sources that proves the robots aren't winning everywhere.
Right.
And in fact, the human element might be staging a massive comeback. On the desk today, we have the BGC Group Q1 2026 Earnings Call Transcript, their official Q1 earnings presentation slide deck, and a slew of supporting financial headlines.
And honestly, looking at the data in these documents, that entire extinct human narrative completely fractures.
It really does.
BGC Group is a traditional interdealer broker with roots firmly planted in those old voice brokerage days, yet their numbers look like, well, a hypergrowth tech anomaly.
Let's actually pause there for a second, because we need to define what an interdealer broker is for you listening before we get into these crazy numbers.
Good call.
Because an interdealer broker is not like the app you use to buy 10 shares of a tech stock. They are the invisible middlemen for the massive Wall Street megabanks.
Exactly.
When a global bank needs to quietly offload, say, $2 billion of government bonds, they don't just dump it on a public exchange. They call an interdealer broker to find another bank willing to take the other side of that trade anonymously.
And that anonymity and scale are crucial to keep in mind here.
Right.
Because our mission today is to decode how this specific kind of business, BGC Group, just delivered a staggering 44% jump in quarterly revenue,
It's wild.
hitting $955.5 million. We are going to explore how they are leveraging technology, strategic acquisitions, and global volatility to actually outpace the fully electronic automated exchanges.
So let's jump straight into the sheer scale of this Q1 record, because the headline shock is it's substantial.
It really is.
Total revenues of $955.5 million. That is up 43.8% year over year. And their pre-tax adjusted earnings hit an all-time high of $232.1 million.
Which is just massive.
Yeah. But to figure out how a traditional brokerage pulls off a 45% earnings increase, we have to look at the macro environment they were operating in.
Right, because during the earnings call, management specifically pointed to the geopolitical landscape. They heavily referenced the Iran conflict that began on February 28th of that quarter.
And real quick, as a strict rule for us at the table, we need to be absolutely clear with you listening. We are not taking any political sides here or endorsing any viewpoints regarding global conflicts.
Exactly.
We are purely analyzing the market impact exactly as it was reported by BGC in their financial disclosures.
Purely the financial mechanics, yeah. Because when major geopolitical conflicts break out, global markets hate uncertainty.
They really do.
And that uncertainty instantly translates into market volatility.
Which is basically the lifeblood of a brokerage.
Precisely. When the news broke, volatility spiked dramatically across energy markets, interest rates, and foreign exchange. Institutions were scrambling to hedge their risks.
Right.
So BGC estimates that this specific geopolitical spike resulted in about $20 million of incremental revenue for the quarter.
Okay, let's unpack this. Because $20 million is a massive amount of money to an individual, but we just said their total revenue for the quarter was $955.5 million.
Right.
That geopolitical bump is like only about 2% of the total pie. The cynical narrative out there is that BGC just got lucky, that global chaos just handed them a record quarter.
Yeah, but the math completely contradicts that.
Exactly. And I want to highlight a critical piece of nuance provided by their CEO, John Abdularash. He explicitly pointed out that through February 27th, which is before the conflict even began, BGC's revenues were already tracking up 41%.
I mean, that single data point is probably the most important number in the entire earnings call.
Seriously.
It completely strips away the excuse of external luck. The underlying structural engine of their business was already running at maximum capacity before the headlines even hit.
It's like looking at a high-speed bullet train. It's already flying down the track at 200 miles an hour, completely under its own power.
Right.
And then at the very end of the trip, there's a slight downhill grade. The grade The geopolitical volatility adds a tiny bit of extra speed, but the train was already crushing the route.
That's a great way to put it.
So if traditional financial volatility wasn't the main engine driving this massive revenue beat, BGC must have found a completely different pond to fish in.
Oh, they absolutely did, and the slide deck lays it out clearly. That brings us to the explosion of their ECS business.
All right, ECS.
Which stands for Energy, Commodities, and Shipping. The data on this segment is staggering. It more than doubled.
Wow.
Yeah, we are talking 120.1% growth year over year, hitting $330 million for the quarter.
And to put that in perspective for you listening, ECS now makes up 35% of BGC's total revenue.
Yeah, a massive chunk.
But I want to make sure we understand the mechanics of what this actually is. When we talk about commodities and shipping, we aren't talking about trading Apple stock. We are talking about the physical realities of the global economy.
Exactly. This is where we get into the OTC, or over-the-counter, markets. Unlike a public stock exchange where standardized shares are traded openly, OTC markets involve bespoke, customized contracts negotiated privately between two parties.
Right.
And a huge catalyst for BGC's dominance here was their acquisition strategy. A year ago, BGC acquired OTC Global Holdings.
Which was a massive deal.
Huge. And integrating a massive complex business that negotiates customized physical commodities is notoriously difficult. But fast forward to today, the integration is virtually complete. So going forward, BGC is going to report this as one unified multi-brand segment.
I have to push back here, though. If they bought a massive company a year ago, it kind of feels like they just bought their way to a record quarter.
I see what you're saying.
Because any company's revenue will double if they just acquire another huge company and bolt those spreadsheets together. So is the underlying pre-existing business actually growing, or is this just like an accounting illusion?
That is always the danger with major acquisitions, but the earnings report strips that illusion away.
Oh, really?
Yeah. Even if you completely isolate the numbers and exclude the OTC Global Holdings acquisition, BGC's standalone legacy business still posted a record 23% revenue growth.
Okay, wow.
The acquisition was a strategic accelerant, absolutely, but the organic engine was undeniably firing on its own.
That's pretty impressive.
It is. And if we connect this to the bigger picture, this fundamentally shifts BGC's entire identity as a corporation. Well, historically, an interdealer broker was completely at the mercy of financial market volatility. If the Federal Reserve wasn't moving interest rates and currencies were stable, trading volume dried up, and brokers didn't make money.
They were basically just waiting around for central banks to do something interesting.
Precisely. But by building out this massive ECS segment, which is now 35% of their revenue, their drivers have completely transformed.
Right, because they're no longer just waiting for the Fed.
Exactly. They are now deeply tied to global energy demand, GDP growth, and the complex logistics of shipping physical freight around the world. Imagine a major European manufacturer that needs to lock in the price of natural gas and secure the cargo ships to transport it for the next 5 years. That is an incredibly complex, high-stakes OTC transaction.
And it also ties them into the global environmental transition, right? Treating environmental products, carbon credits, transitional energy sources.
Oh, absolutely.
Because those aren't just short-term financial blips. Those are multi-decade structural shifts in the global economy. BGC basically built themselves a massive shock absorber. If traditional financial markets get boring and quiet, the physical world of energy and shipping keeps the revenue pumping.
It is brilliant diversification.
Yeah.
But we really can't ignore the execution side of this equation either.
Right.
Because it's not just what they are trading, it's how they are executing these massive institutional trades.
Which brings us to the technological transformation happening under the hood. Here's where it gets really interesting, because the numbers here show BGC taking the fight directly to the monolithic electronic exchanges.
Yeah, they really are.
Let's look at FMX, their trading platform. Their U.S. Treasury average daily volume, or ADV, hit a record $89.7 billion in the first quarter.
It's a huge number.
That means they captured a massive 41% market share. Just a year ago, they were sitting at 33%.
And gaining 8% market share in U.S. Treasuries in a single year is a massive land grab. It just doesn't happen very often.
No, it doesn't.
And the tech footprint expands beyond just treasuries, too. Lucera, which is their infrastructure software business providing real-time connectivity to capital markets, grew by 23%.
Mhm.
And Phoenix, their broader electronic trading platform, hit a record $207 million.
And if you look at the slide deck, there is a fascinating David versus Goliath dynamic playing out here. BGC provides data showing that their listed revenues are actually outpacing the volume growth of massive, fully electronic exchanges like CME and IC.
Yeah, that slide was very telling.
Furthermore, FMX is aggressively pitching itself as the vital second player in a market that desperately wants an alternative to those monopolies. They specifically highlight that FMX's SOFR prices are equal to or better than CME's 64% of the time.
We should probably define SOFR for the learner because it's literally the bedrock of modern finance.
Yes, definitely.
So SOFR stands for the Secured Overnight Financing Rate. In very simple terms, it is the benchmark interest rate that banks use to price dollar-denominated derivatives and loans. So when FMX proves they can beat the incumbent monopoly on pricing nearly 2/3 of the time on the most important interest rate in the world, the mega banks are basically forced to route their trades through BGC.
But this brings me back to the core premise we started the show with. Conventional wisdom dictates that fully automated, low-touch electronic platforms will eventually eat human, high-touch brokers alive.
That's the theory, yeah.
Right, because algorithms don't need health insurance, they don't sleep, and they are mathematically faster. So why is BGC, a company with such deep roots in traditional human voice brokerage, growing faster than the fully electronic exchanges?
The answer to that lies in a really profound point made by co-CEO JP Aubin on the call.
What did he say?
He pointed out that BGC functions exactly like an exchange, but they offer clients 3 distinct ways to execute a trade. They can do pure voice with a human broker, a hybrid mix of voice and screen, or fully electronic execution.
Okay, I understand the flexibility, but why would a massive institution ever choose a human over a lightning-fast algorithm?
Because of how algorithms are programmed to handle risk. Think about the mechanics of a fully electronic exchange during a panic.
Okay.
Algorithms are coded with strict risk parameters. When geopolitical news breaks and volatility spikes beyond a certain threshold, the algorithms don't try to be heroes.
Right.
They are programmed to literally pull their money off the table to avoid catastrophic losses.
So the screen just goes blank.
Exactly. The liquidity completely evaporates.
Uh,
Now imagine you are a trader at a mega bank and you suddenly need to offload $1 billion of U.S. Treasuries during a market panic. You look at your screen and the electronic exchange has frozen up because the algorithms are hiding.
that sounds terrifying.
It is, and that is when you absolutely must pick up a physical phone. You need a trusted human broker.
Right, someone who actually knows where the hidden pockets of liquidity are.
Exactly. Someone who can negotiate a massive, complex block trade anonymously without crashing the market price further.
That is a phenomenal distinction. The robots are great for, like, high-volume, low-stress environments. But when the house is on fire, the algorithms run out the back door, and you need a human to navigate the smoke.
Perfectly said.
Because BGC offers all 3 execution methods, they capture the revenue whether the client wants to click a mouse on a quiet Tuesday or scream into a phone during a flash crash.
And that technological integration leads to a really fascinating metric in their slide deck regarding human productivity. BGC's front office productivity has climbed to an astonishing $1.3 million per producer.
Just to clarify, a producer is a front office broker, right?
Yes.
So every single human broker, on average, is generating $1.3 million in revenue. That's insane.
It is. It proves that BGC's technology isn't replacing the human brokers. It is making them exponentially more efficient.
Right. The tech handles the administrative friction, allowing the human broker to focus entirely on high-value relationship building and complex negotiations.
Exactly.
So what does this all mean? Because this is where the narrative gets incredibly contradictory for me.
Okay, how so?
Well, they just crushed earnings. Their brokers are generating $1.3 million each, yet management announced they are aggressively slashing costs.
Right, the cost reduction program.
Yeah, they expanded their cost reduction program from $25 million up to $35 million, primarily through compensation cuts and closing down an unprofitable OTC logistics business.
Mm-hmm.
And on top of that, their liquidity dropped down to $878 million, and they are predicting surprisingly sluggish growth for the next quarter. Their Q2 revenue guidance is between $785 and $845 million, which is only about 4% year-over-year growth at the midpoint.
Yeah, it looks a bit confusing on the surface.
Are they stepping on the gas and the brake at the exact same time?
This raises an important question. How do you reconcile record-breaking growth with a highly conservative outlook and aggressive cost-cutting?
Exactly.
To understand it, we have to strip away the sensationalism and look at the actual accounting mechanics, starting with that liquidity drop.
Right, because dropping from roughly $979 million down to $878 million in cash usually triggers alarm bells.
It does, but in this specific sector, it's just standard Q1 seasonality. The first quarter of the year is when Wall Street pays out its massive year-end bonuses to those highly productive brokers.
Of course.
It is also when major corporate tax settlements occur. That cash didn't vanish due to bad business. It was a completely scheduled, expected payout cycle.
Okay, so the cash drop makes sense. It's just the cost of keeping elite talent on Wall Street.
Right.
But you can't explain away the sluggish 4% growth guide for Q2. I mean, after growing 44%, telling your investors you only expect 4% growth next quarter feels like admitting the engine just died.
It definitely looks that way until you understand what they are comparing themselves against. When a company reports year-over-year growth, they are comparing this coming Q2 to the Q2 of last year.
Yeah.
And last April, the global physical markets experienced a massive one-off anomaly known as Liberation Day.
Oh, I saw that referenced in the deck. The tariffs, right?
Yes. Let's explain the mechanism of what happens when sudden, massive tariffs are introduced to a sector.
Right.
When a new tariff hits, the physical price of goods shifts violently overnight. Every single major player holding shipping contracts or physical commodities suddenly finds their math is wrong.
Oh, wow.
They have to immediately rush to the market to restructure and re-hedge their positions to account for the new tax. This creates an unnatural, frantic frenzy of trading volume. BGC estimates that the Liberation Day event artificially inflated last year's Q2 revenue by about $20 million.
I see. So it's not that BGC expects to do poorly this coming quarter. It's that the bar they have to jump over was artificially raised by a historic panic last year.
Precisely. And you have to layer one more factor on top of that. BGC recently sold off their case business and intentionally wound down that unprofitable logistics arm we mentioned earlier.
Which the transcript noted removed about $10 million in quarterly revenue from their books.
Exactly. So if you normalize the data, if you adjust for the $20 million tariff spike they won't have this year, and you subtract the $10 million in revenue they intentionally sold off, the underlying organic growth for the first half of the year is actually tracking closer to 13%.
Okay, that makes so much more sense.
Right. Trading isn't stalling. It is simply returning to a state of normality after a highly anomalous period. Management isn't hitting the brakes. They are just guiding conservatively against a very tough, unnatural mathematical comparison.
That completely flips the perspective.
Yeah.
It's the difference between losing momentum and simply driving on a flat road after coming down a massive hill.
Exactly.
And I suppose that also explains the aggressive cost cutting. A well-managed firm doesn't wait until they are losing money to optimize their margins. By expanding their cost cuts to $35 million now, they are locking in their profitability for when that geopolitical volatility inevitably cools down.
It's the definition of disciplined management. They are fixing the roof while the sun is shining, or in this case, while the revenues are pouring in.
Bringing all these threads together for you listening, whether you are an investor analyzing the future of fintech or just someone fascinated by how global markets absorb macro shocks, BGC Group is a masterclass in hybrid resilience.
They have built a global platform designed to capitalize on chaos, but heavily insulated by structural diversification. They are diversified geographically, they are diversified across asset classes from interest rates to shipping freight, and most critically, they are diversified across execution types.
They give the massive institutional client exactly what they want, exactly when they need it.
Precisely.
Which leaves us with a truly fascinating thought to end on today. Because as AI and algorithmic trading continue to relentlessly advance, standard, low-touch electronic execution is going to become completely commoditized. It will be cheaper, faster, and universally available.
Yeah, it just becomes a race to the bottom for fees. When everyone has an algorithm, the algorithm itself is no longer a competitive advantage.
Exactly. So as the robots take over the easy, standardized stuff, will the ultimate premium in the future of finance actually revert back to the human element?
It's a great question.
BGC's success strongly suggests that the white glove trust, the ability to execute massive anonymous trades during a panic, and the hybrid connectivity of expert human brokers backed by elite technology. That might be the one true moat algorithms can never replicate.
The technology doesn't replace the human, it elevates the human, making their intuition and relationships exponentially more valuable.
It makes you wonder what other highly automated industries out there might soon see a massive resurgence in human-led tech-assisted services. If the old-school human broker can beat the purely electronic exchange by using the technology to their advantage, the future of work might look very different than we think.
Absolutely.
Something for you to ponder until next time. Thanks for joining us for this deep dive, learner. We'll catch you on the next one.